What if the biggest financial disasters in history didn't happen because people were stupid, but because they were confident? What if every generation believes it is smarter than the last, yet somehow ends up making the exact same mistakes again and again, from ancient empires to modern stock markets? From tulips to tech stocks, from housing booms to crypto manias, financial bubbles don't just happen randomly. They follow a pattern, a disturbingly consistent pattern. And here's the most uncomfortable truth. The people inside a bubble almost never realize they're in one. They have charts, they have experts, they have new theories. They believe this time is different, but history disagrees. In this video, we're going to uncover why financial bubbles form, how they grow, what causes them to collapse, and why every attempt to stop them keeps failing. And as we move forward through history, one question will keep haunting us. If we know how bubbles end, why do we keep repeating them? The answer isn't just financial. It's psychological. And it's still shaping markets today. To understand financial bubbles, we first need to understand something more basic: money itself. Money isn't just currency. It's trust. Trust that paper has value. Trust that numbers on a screen represent real wealth. Trust that someone else will buy what you own for more. That trust is the fuel of every financial system. And when trust turns into belief without limits, bubbles are born. Throughout history, financial systems evolved to solve real problems: how to trade efficiently, how to store wealth, how to fund growth, but every improvement came with a side effect: leverage. Leverage allows people to control more assets than they can afford, using debt, speculation, or promises of future value. And leverage is what turns optimism into catastrophe. At first, bubbles don't look dangerous. They look like progress: new trade routes, new technology, new housing demand, new financial instruments. Each bubble starts with something real. The danger begins when price detaches from reality and belief replaces value. The year is 1637. The place is the Dutch Republic. One of the richest societies on earth, the Netherlands had everything: global trade dominance, a strong currency, advanced banking, a wealthy middle class, and most importantly, excess capital. That money needed somewhere to go. Enter the tulip. Tulips were rare, exotic, and imported from the Ottoman Empire. Certain varieties were unique due to a virus that created dramatic color patterns. These tulips became status symbols, the luxury goods of their time. At first, prices rose slowly. Collectors bought them, gardeners traded them. Then something changed. People began buying tulips not to plant, but to sell later. A new idea took hold: if the price is rising, it will keep rising. Soon, tulip contracts were being traded in taverns. Farmers sold land. Craftsmen quit jobs. People borrowed money to buy flowers that hadn't even bloomed yet. Tulip prices reached absurd levels. Some bulbs were worth more than a house. But no one asked the most important question: who will buy this next? And at what price? That question is always ignored at the peak. Here's where bubbles become truly dangerous. Prices don't rise linearly. They rise exponentially. As prices go up, early buyers feel validated, skeptics feel foolish, media attention explodes, new participants rush, and people don't want to miss out. This is a FOMO, fear of missing out, and it's older than modern psychology. In Tulip Mania, people believed they had discovered a new asset class. In later bubbles, the language would change: new economy, permanent growth, scarcity, revolutionary innovation, but the emotion stays the same. The rise phase is fueled by 1. Easy money, 2. Social proof, 3. Success stories, 4. Confirmation bias, losses are ignored. Warnings are mocked, and something subtle but dangerous happens: the bubble starts feeding on itself. Prices rise because people believe prices will rise. At this point, fundamentals no longer matter. Every bubble reaches a moment of silence, not a crash or a pause. In the Dutch tulip markets, buyers simply stopped showing up. Auctions failed. Contracts went unpaid. Prices stalled. And that's all it took, because once prices stop rising, the illusion breaks. People don't ask, is this worth the price? They ask, what if I can't sell? That shift turns greed into fear. And fear spreads faster than optimism. Suddenly, credit dries up, buyers vanish, sellers panic, tulip prices collapse by more than 90% in weeks. Wealth evaporated. And what shocked people most wasn't the loss of money. It was the realization that nothing had Changed except belief. The tulips were the same. The economy was the same. Only confidence had vanished. After every bubble bursts, the same question appears. Who is responsible? Speculators blame bad luck. Governments blame greed. The public blames elites. But the damage always falls hardest on late buyers, ordinary households, workers. Not insiders. Those who entered at the top lose everything. Those who exited early quietly move on. And institutions promise reforms. Rules are written. Regulations are passed. Warnings are issued. History takes notes. And then forgets. After Tulip Mania, authorities tried to control speculation. They failed. After later bubbles, governments did the same, with the same results. Why? Because financial bubbles aren't just market failures. They are human behavior failures. As long as people chase fast wealth, credit exists, optimism cycles repeat, bubbles will form. Each generation believes it has better tools, better data, better models, and each generation underestimates emotion, which brings us to a disturbing realization. Bubbles are not accidents. They are features of financial systems, and we're only getting started. Tulip Mania taught the world a lesson, but instead of avoiding bubbles, humanity learned how to build larger ones. As economies grew more complex, so did financial systems. Governments realized something powerful and dangerous. If speculation could fuel private wealth, it could also fund public ambition. By the early 1700s, European empires were drowning in debt from wars, expansion, and colonial projects. Taxes weren't enough. Gold was scarce, so governments turned to financial engineering. This is where bubbles stopped being fringe events and became state-backed phenomena. In 1720, England, the South Sea Company promised something extraordinary. It would take over Britain's national debt in exchange for exclusive trade rights with South America. The problem: Britain didn't actually control South American trade. But the story was compelling. Exotic markets, endless riches, government approval, parliament backed it, the king invested, elites promoted it, and the public followed. South Sea Company shares exploded in price. People didn't buy because they understood the business. They bought because authority endorsed it. This was new. For the first time, a financial bubble had government legitimacy, political incentives, national pride attached. And when it collapsed, it wasn't just investors who suffered, it was the entire British economy. Confidence in markets shattered. But something even more important happened afterward. After the crash, governments promised reforms, tighter rules, more oversight, fewer speculative schemes, and for a while, bubbles slowed. But here's the catch: regulation fades, memory doesn't last, incentives remain. As decades passed, new industries emerged: canals, railways, factories. Each innovation was real. Each created genuine growth. And each became the foundation for a new bubble. The railway mania of the 1800s followed the same pattern: revolutionary technology, massive infrastructure spending, credit speculation disguised as progress. Railways did change the world, but investors stopped asking, will this railway make money? And started asking, who will buy my shares next? Sound familiar? This is where bubbles evolve. They stop being about assets and become about expectations. By the time railways overexpanded, capital was misallocated. Debt piled up, and crashes followed. Yet every time, the explanation was the same: the idea was right, the timing was wrong. That sentence has justified bubbles for centuries. Then came the stock market. For the first time, millions of ordinary people could speculate together. And in the 1920s, America believed it had entered a new era. Productivity surged. Technology advanced. The middle class invested. And a dangerous phrase took hold: stocks only go up. People borrowed money to buy shares. Banks encouraged speculation. Margin trading exploded. When prices rose, confidence grew. When confidence grew, leverage increased. The system became fragile. Then in 1929, the pause came. Not the crash, the hesitation. Selling increased. Liquidity vanished. Fear spread. The Great Depression followed. And the cost wasn't just financial. It was human. Millions lost jobs. Savings disappeared. Trust in capitalism cracked. Surely, this would be the end of bubbles. It wasn't. After the Depression, central banks were given a new mission: prevent collapse at all costs. Interest rates became tools. Money supply became adjustable. Liquidity became policy. These tools stabilized economies, but introduced a new problem. Cheap money doesn't just stimulate growth, it encourages risk. When borrowing is easy, asset prices inflate speculation, increases debt piles up quietly, and because crashes are painful, central banks intervene, lowering rates further. This creates a cycle. Each crash is softened, each recovery is faster, each bubble grows larger. The system learns the wrong lesson. Risk is rewarded, losses are temporary. In the late 1990s, the internet arrived, and it really was revolutionary. But once again, reality didn't matter. Companies with no profits, no revenue, no business model reached billion-dollar valuations. Why? Because people believed the old rules no longer applied. This time is different. When the bubble burst in 2000, trillions vanished, but the response was familiar. Interest rates slashed, liquidity injected. Confidence rebuilt, and that response planted the seeds for the next disaster. Low interest rates made borrowing cheap. Homes stopped being places to live. They became investments. Banks created complex financial products. Risk was hidden, repackaged, and sold. And once again, prices rose, skeptics were ignored, warnings were dismissed until 2008. When housing collapsed, the entire global financial system froze. Governments stepped in, banks were bailed out, markets were saved. But something changed forever. After 2008, markets learned a dangerous truth. The bigger you are, the safer you are. Losses would be socialized. Gains would remain private. This distorted incentives. Speculation returned, faster and louder. Stocks, crypto, real estate, tech valuations. Each wave claimed uniqueness. Each followed the same structure. Today's markets are defined by record debt, ultra-low interest rates, massive asset inflation. Prices rise not because of fundamentals, but because liquidity flows somewhere. Social media accelerates bubbles. Narratives spread instantly. Hype travels faster than data. And once again, the belief returns. This time, it's different. History disagrees. Takeaway number 1. Bubbles start with something real and end with belief. Innovation isn't the problem. Overconfidence is. Takeaway number 2. Easy money amplifies human weakness. Low rates don't remove risk, they hide it. Takeaway number 3. The crash isn't the failure, denial is. Bubbles burst when reality reasserts itself. Every generation inherits the same financial system and convinces itself it has outgrown the past. But bubbles don't care about intelligence. They care about incentives. So the real question isn't, will there be another bubble? It's, who will recognize it before belief collapses? If this video changed how you see markets, history, or risk, share it with someone who believes this time is different. Subscribe for deep dive financial documentaries that explain not just what happens, but why it keeps happening. Because history doesn't repeat itself by accident. It repeats because we let it.